Imagine finally buying your dream home, holding the keys in your hand, and feeling that wave of pride. The paperwork is signed. The deal is closed. You believe you've just secured stability for your future. But what many people don't realize is that the paper you signed is not just for shelter. It is a contract for 3 decades of payments, and it will end up costing far more than the price of the house itself. Take a standard $300,000 mortgage in the US with a 6% interest rate. On the surface, it looks simple, about $1,800 a month. It feels manageable, almost like paying rent. But here's the hidden truth. Over 30 years, you won't pay $300,000. You will pay more than $600,000. The bank essentially collects the value of a second home from you, and they do it without ever laying a single brick. The trap gets worse in the beginning. In the first years of your loan, almost all of that $1,800 goes to interest. Out of the full payment, maybe $1,500 disappears into the bank's pocket. Only $300 actually reduces the debt you owe. So you keep working. You make every payment on time, but your balance barely moves and progress feels impossible. That's why so many Americans feel stuck in their mortgage. They start the journey with excitement, but later, they realize it's like running on a treadmill that never slows down. Here's the part most people never hear about. There is a way to bend the rules of your mortgage without being rich. The strategy is called prepayment. It means making extra payments that go directly toward the principal instead of feeding interest. Even small amounts can completely change your financial future. An extra $200 a month may not sound like much, but it can cut 4 or 5 years off your loan and save tens of thousands in interest. A single lump sum, like a tax refund, a bonus, or the sale of a used car, can slash almost a decade from your timeline. This isn't magic and it isn't a trick. It's just the mathematics of interest and time. Your mortgage is not unchangeable. It can be shortened, reshaped, and eliminated years earlier than you were told. And once you understand this, you will never look at your mortgage or your bank the same way again. When most Americans sign a 30-year mortgage, they believe each monthly payment slowly reduces their debt. But the truth is that the system is designed to protect the bank first, not the borrower. The structure of a mortgage front-loads interest, which means in the early years, your payments barely touch the principal. Take that same $300,000 loan at 6% with a monthly bill of $1,800. Look at the very first statement, and you'll see the hidden math. Out of that $1,800, around $1,500 goes straight to interest. Only about $300 is applied to lowering your balance. So, after a full year of paying $1,800 every single month, your debt has dropped by only a few $1,000s. Meanwhile, the bank has already collected nearly $18,000 in interest from you. That is why homeowners often feel like they are standing still, even after years of consistent payments. The frustrating part is that the balance barely moves at first, and most families don't realize why. They assume they are making progress when in reality they are mostly paying rent to the bank. It's rent inside their own home, and the landlord is the lender. 5 years later, many borrowers look at their statement and are shocked. They have paid tens of thousands of dollars, yet the principal is still close to what they borrowed. It feels like running a marathon where the first miles are all uphill. But here is the important detail. As the years pass, the ratio begins to shift. Gradually, more of your monthly payment goes toward principal and less toward interest. By the final years of the loan, most of the $1,800 is paying down debt instead of feeding the bank. The system isn't broken. It's built this way on purpose. It ensures the bank makes its profit early before you ever have the chance to pay the loan off. And this is exactly why prepayments are so powerful, because they break this timeline and push you forward instantly. Before we keep going, let me pause for just a second. If you're enjoying this breakdown, hit the like button and subscribe for more stories that reveal how money really works. And let me throw you a question that most people wonder about. If you had an extra $200 or $500 each month, would you put it into your mortgage, or would you invest it in the stock market, an IRA, or maybe REITs? It's a tricky choice, and the surprising answer is not what most people think. We'll get there later in this video, so stick around until the end. Most homeowners think they are locked into their mortgage schedule with no way to escape the 30-year timeline, but that isn't true. Because there is a strategy hiding in plain sight that changes everything. It's called prepayment, and it means putting extra money directly into the principal balance. Unlike your regular payment, which mostly goes to interest at the start, every prepayment goes straight to reducing the debt itself. That small detail creates an enormous impact because cutting the balance early means future interest has less to grow on. Think about it like climbing a mountain. The bank sets the path to last 30 years, but prepayments let you skip steps and reach the top faster. Even small numbers add up in surprising ways. An extra $50 a month can cut off nearly a year of payments. An extra $100 a month can save you around 2 years. And $200 a month can reduce your mortgage by 4 to 5 years. It doesn't take doubling your income. It doesn't take winning the lottery. It only takes consistency and the decision to direct small amounts toward principal. The effect compounds over time because every dollar of principal you erase today is a dollar that never collects interest tomorrow. So a few hundred extra dollars now can prevent tens of thousands in future costs. Some people use tax refunds. Others use annual bonuses. Even selling an unused car or trimming a few lifestyle expenses can create a lump sum that slashes years from the timeline. The beauty is that prepayment is flexible. You can add small amounts monthly or larger sums whenever money becomes available. Both approaches bend the schedule in your favor, and the bank cannot stop you. This is the power most people never hear about. It's not investing. It's not speculation. It's simply flipping the mortgage math back toward you. And once you see how effective it is, you'll wonder why banks never advertise it. Many people assume that only huge amounts of money can make a difference in a mortgage. But the truth is that even small, steady contributions can shave years off the schedule. Imagine adding just $50 every month to your payment. That amount could eliminate almost a full year of debt over time. It's like skipping 12 payments without ever missing one. Now, raise it to $100 a month. That change alone could cut 2 years off your mortgage and save tens of thousands in interest. At $200 extra, the results become dramatic. You're not just saving a little, you're cutting 4 or 5 years from the loan. That's more than 50 monthly payments erased simply by adjusting your budget. It doesn't require extreme sacrifice. Many families find this money by cutting unused subscriptions, delaying upgrades, or redirecting tax refunds. Every small cut in lifestyle becomes a big cut in debt. Think about a family who uses their $2,000 annual tax refund as a prepayment every year. By itself, that one decision can remove nearly 8 years from a 30-year mortgage. Or consider a couple who channels a yearly bonus of $5,000 straight into principal. Over a decade, they will have eliminated more than half their mortgage term. These numbers sound surprising, but they come straight from the math of amortization. Each dollar paid early cancels out interest that would have grown for decades. And those decades are what cost people hundreds of thousands. That's why small, consistent prepayments are so effective. They don't just reduce debt, they accelerate the timeline in ways most homeowners never imagine. And the sooner you start, the bigger the impact becomes. Most homeowners never consider what would happen if they added a full extra payment every month. Take the same $300,000 mortgage at 6% with a standard payment of about $1,800. If you only pay the required amount, the loan runs the full 30 years. The total paid in that case is about $647,500. Now, imagine doubling the monthly payment to around $3,600. Instead of finishing in 30 years, the mortgage ends in just over 9 years. That means you cut more than 2 decades from your timeline. And the total paid in this scenario is about $389,000. Compare the two outcomes. In the normal case, interest costs you almost $348,000. With double payments, interest falls to about $89,000. The difference is roughly $258,000 in savings. That is the true power of paying extra toward principal. Almost the entire second payment goes straight into reducing debt. And the earlier you start, the more future interest you erase. Of course, not every family can sustain doubling payments month after month, but even 1 or 2 full extras per year can still shorten the loan significantly. 1 extra full payment each year cuts about 4 to 5 years off the schedule. 2 extras per year bring it down even further. The key is to make sure every extra is applied directly to principal. That is what accelerates the payoff and changes the numbers in your favor. So, whether it's consistent doubling or occasional extras, the math works the same way. Every full payment added brings the finish line closer and saves thousands in interest. And once you see how fast a 30-year mortgage can collapse, it changes how you think about debt forever. When you make an extra payment, most banks give you two options. You can choose to reduce the size of your monthly payment, or you can choose to reduce the total length of the loan. At first glance, lowering the monthly bill sounds attractive. It gives immediate relief and your budget feels lighter each month. But the real savings usually come from cutting the timeline, not the payment size. Imagine you owe $300,000 at 6% with a 30-year term. If you apply $10,000 toward principal and ask to reduce your payment, your bill might drop from $1,800 to about $1,740. It feels nice, but you will still be paying for decades. Now, take the same $10,000 and apply it to shorten the timeline instead. Your monthly bill stays close to $1,800, but the loan ends several years earlier, saving you tens of thousands in interest. This is the critical choice every borrower faces when making extra payments. Do you want short-term comfort or long-term freedom? A lighter monthly burden or a faster finish line? The smart move for most people is clear. Direct every extra payment toward reducing the term, because interest grows with time, and cutting time is what destroys interest. It's like choosing between carrying a smaller backpack or ending the hike miles earlier. One eases the load a little, the other gets you home much faster. That's why homeowners serious about financial freedom almost always pick the timeline option. Every extra dollar brings the payoff date closer. And once you start knocking off years, the psychological effect is as powerful as the financial one. You stop feeling like you are stuck for life, and you start seeing the finish line come closer each year. Money is not only numbers on a page, it also shapes how people feel every single day. Carrying a mortgage for 30 years is not just a financial burden, it is an emotional weight. Knowing that you owe hundreds of thousands for decades affects the way you sleep, plan, and even dream. When the balance moves slowly, frustration builds. You pay every month, but the statement looks almost the same. It feels endless, and that sense of being trapped creates stress that never fully leaves. Now imagine the opposite scenario. You make extra payments and suddenly the payoff date moves closer. Instead of 30 years, it shows 25, then 22, then 19. Each year cut off the schedule is like taking a stone out of a heavy backpack. Families that accelerate payments often report something surprising. It's not just about saving money, it's about gaining peace of mind. The house starts to feel like it is truly theirs, not the bank's. They sleep better, fight less about money, and plan further into the future. Research shows that debt stress is one of the biggest causes of anxiety in households, and long-term mortgages are among the most common sources of that stress. But prepayment changes the psychology completely. Every time you send an extra check, you are not just reducing numbers, you are buying peace. You are proving to yourself that the loan does not control you. The sense of progress gives you energy to keep going. Financial freedom starts in the mind before it shows up on the balance sheet. And when your mortgage timeline collapses, you don't just save interest, you save years of worry. That invisible pressure disappears and your future feels lighter, clearer, and far more possible. And by the way, remember that big question. Is it smarter to prepay or invest? We'll answer that before we wrap up. It's one thing to talk about prepayment in theory, but let's look at the numbers in practice. Take again a $300,000 mortgage at 6% with the standard $1,800 monthly payment. Over 30 years, the total paid is about $647,500, with nearly $348,000 going only to interest. Now imagine adding $200 every month. The loan shortens by about 4 to 5 years. The interest saved is close to $60,000. That's the power of a relatively small monthly change. What if you raise it to $500 a month? The mortgage shrinks by nearly 9 years. The total interest saved jumps to more than $120,000. That's enough to fund a child's college tuition or secure a retirement account. Another common strategy is one extra full payment per year. That simple pattern turns a 30-year mortgage into about 25 or 26 years. It may not sound like much, but it erases 50 to 60 payments, which equals years of freedom. Lump sums can be even more powerful. Drop $10,000 into the principal early on, and you might erase 7 to 10 years from the schedule. The earlier you do it, the greater the effect, because the money cancels decades of future interest growth. Now, imagine combining strategies. $200 extra each month, plus one extra payment per year, plus the occasional lump sum when money allows. Together, these moves can cut a 30-year mortgage down to less than 20 years. The difference in cost is staggering. Instead of paying almost $650,000 for a $300,000 home, you might pay closer to $500,000. That's $150,000 staying in your pocket instead of the bank's. These are not exaggerated numbers. They are based on standard mortgage math in the US, and they prove that prepayment is not a trick. It is simply using the rules of interest against themselves. If prepayment is so powerful, you may wonder why banks never talk about it. The answer is simple. The system works better for them when you don't know. Banks design mortgages to guarantee decades of steady income. 30 years of interest payments create predictable profit, and the earlier those interest dollars come in, the safer the bank feels. When you make extra payments, you disrupt that model. You cut off streams of future interest before the bank can collect them. From their perspective, every prepayment is lost revenue. That's why most servicers process prepayments quietly. The option is there, but you have to request it. They rarely advertise it, and they almost never encourage it. Think about the ads you see from lenders. They promote low monthly payments, they highlight easy approvals and long terms, but they never say, "Here's how to pay us less." It's not a conspiracy, it's simply business. The less time you spend in debt, the less profit the bank makes, and the longer you stay, the more money they earn from your loan. This knowledge gap keeps millions locked into the full 30 years. People assume the schedule cannot be changed because no one tells them otherwise. And that assumption is exactly what the system depends on. But once you understand prepayment, the silence makes sense. You realize you are playing by rules written for the bank, and you finally see that you have the power to rewrite them. The mortgage doesn't have to last 30 years unless you allow it. The tools to shorten it are already in your hands. And the only reason most people never use them is because no one ever showed them how. When most people think about investing, they imagine the stock market or real estate. But few realize that one of the best guaranteed returns sits right in front of them. Every extra dollar you put into your mortgage delivers a risk-free return equal to your interest rate. On a 6% loan, prepayment is the same as earning 6% after tax with zero risk. That's a return many investors dream about, but without the volatility of markets. It doesn't depend on luck. It doesn't depend on timing. It's built into the math of your loan. Cutting years from your mortgage is more than saving money. It's creating certainty. You know exactly how much you will save the moment you make the payment. That kind of guarantee is rare in finance. Now compare two futures. In one, you follow the schedule and spend 30 years paying the bank. In the other, you apply prepayments and finish in half the time, saving hundreds of thousands. Which version gives you more freedom? Which version lets you build wealth earlier, invest sooner, and plan without fear? Because once the mortgage is gone, every dollar you use to send to the bank stays with you. That cash flow can fund investments, education, or retirement years ahead of schedule. Debt-free, your money finally works for you instead of against you. That's the ultimate return. Not just the interest you save, but the life you reclaim. The years you win back are worth more than any percentage. Your home should be where you live, not where the bank makes its living. And every extra payment is a step closer to that reality. So ask yourself this simple question. If you could buy back years of your life today, why would you wait? Every homeowner eventually asks the same question. If I have extra money, should I put it into my mortgage or invest it? The honest answer is that it depends on goals, risk tolerance, and discipline. Prepayment is simple, guaranteed, and risk-free. Investments carry risk, but also potential for higher returns. Take an example. Suppose you have a 6% mortgage and $200 extra each month. If you prepay, it's like locking in a 6% after-tax return with no chance of loss. That is better than most safe investments available. But what if you invested that $200 into an S&P 500 index fund? Historically, the long-term return has averaged 7 to 10% per year. That beats 6%, but the keyword is long-term, and with volatility along the way. In some years, the market falls 20%, and not everyone can stomach that risk. There are also behavioral traps. Many people plan to invest the extra, but end up spending it instead. Mortgage prepayment forces discipline, because once you send the money to the loan, it is gone from temptation. Another factor is taxes. Contributing to a 401k or IRA can create tax advantages that prepayment does not. For some families, those accounts may be a smarter first step before attacking the mortgage. So, how do you decide? If you value certainty, hate debt, and want guaranteed savings, prepayment is the winner. If you have a strong stomach for risk, a long horizon, and tax-advantaged accounts available, investing may outperform. The truth is, you don't have to choose only one. Many people split the strategy. They invest part of their surplus and prepay part of their mortgage. That way, they build wealth while also cutting years of debt. The key is not pretending the mortgage is harmless. Ignoring it for 30 years will always cost a fortune. Whether you prepay, invest, or do both, the important part is being intentional with every extra dollar. If this video helped shift your perspective, hit like and subscribe for more stories that reveal how money really works. And let me ask you this. If you had to choose, would you rather buy back years of freedom by paying your mortgage faster, or chase higher returns by investing the extra money elsewhere? Drop your answer in the comments, because that decision says more about your future than almost anything else. And if you want to go deeper, don't stop here. Click on one of the videos on your screen right now. Each one will take you further into the strategies, history, and mindset shifts that can change the way you build wealth forever.